All right, today we're tearing down a really fascinating research report. It lays out this detailed strategy for generating some serious passive income, and it's all centered on the industrial giant Stanley Black & Decker. So let's get right into it.
So with interest rates where they are now, your savings account is probably finally earning you something, right? But the source material we're looking at today asks a really interesting follow-up question. Can we do even better? Without taking on some crazy amount of risk.
And here is the answer the report drops on us: a potential annualized return of 9%. Now that is a number that makes you sit up and pay attention, especially when they're calling it a defensive strategy. So, how in the world is that even possible? Let's unpack the logic.
Here's what we're going to cover. First, we'll tackle the puzzle of that 9% return. Then we'll break down exactly how the trade works. After that, we'll get into this idea of a defensive fortress, look at the valuation safety net, assess the single biggest risk they identify, and then wrap it all up by asking, is this a fortress or is it a trap?
Okay, first up, the 9% passive income puzzle. Let's see how the report actually makes the case for hitting a number this high in today's market.
So the big idea here is actually pretty simple. It's not about finding some magical single investment that just spits out 9%. No, the whole strategy is about stacking two different income streams on top of the exact same pile of money. The source calls it a double-dip income stream, which is a pretty great way to think about it.
And that brings us to the mechanics. Let's get down to brass tacks and see how this thing is actually built, using something called a cash-secured put.
The source uses a fantastic analogy here. Think of it like you're selling insurance on a stock. Someone out there is worried the price of Stanley Black & Decker might go down, so they pay you cash, a premium, today. In return, you agree to buy their shares, but, and this is the key, only if the price drops to a much lower level that you've already set. You're literally getting paid for your willingness to buy a stock you like at a big discount.
And here are the actual numbers from the report. The company is Stanley Black & Decker, ticker SWK. The most important number to look at is the $60 strike price. That's almost 17% below where the stock was trading. Just for agreeing to maybe buy it at $60, you get paid a premium right away. That immediate cash actually lowers your real break-even price to $59.60. And this whole deal has a short 45-day lifespan.
So where does that big 9% number come from? Well, it's broken into those two streams we talked about. First, the premium you get paid for selling the contract, when you annualize it, comes out to over 5%. And second, the cash you have to set aside to back up the trade, your collateral, it doesn't just sit there doing nothing. You can stick it in something safe and earn interest, which the report puts at around 3.6%. You add those two together and bingo, there's your 9%.
Okay, a 9% yield is awesome. But you're probably thinking, what's the catch? Is it safe? Well, that brings us to the real heart of this report, the argument for why this isn't just a high-yield play, but a defensive fortress.
The source lays out three main layers of safety. First, it argues that at $60 a share, the stock is just plain cheap based on its own history. Second, there's this cool concept they call yield gravity. We'll look at that in a sec. And third, the company is right in the middle of this massive $2 billion cost-cutting plan, which acts like a big financial cushion.
This chart really shows that yield gravity idea perfectly. At its current price, the stock's dividend is a pretty solid 4.6%. But here's the thing. If the stock price were to fall to your $60 strike price, that same dividend payment suddenly yields over 5.5%. The point is, as the price drops, the stock automatically becomes way more attractive to income investors, which creates this sort of natural floor of buyers.
And this quote from the source material really hammers it home. They argue this isn't just a theory, it's a threshold that in the past has acted like a hard floor, attracting the big money, we're talking institutional capital, that comes in and actively defends that price level.
All right, let's dig a little deeper into that first layer of defense, the valuation safety net. This is all about why that $60 price is seen as a mathematical floor, not just a psychological one.
The report looks at a pretty standard metric, the price-to-earnings, or PE ratio. At the time of the report, the stock was trading at about 16 times its earnings. But at your $60 strike price, you'd be getting it for just 13 times earnings. For a company like Stanley Black & Decker, the source calls that level deep value, a price that's usually only seen during huge economic downturns.
Of course, no investment thesis is legit without looking at what could go wrong. The report zeroes in on one major threat hanging over the whole thing, calling it the tariff sword of Damocles.
So on one hand, the threat is real. The source acknowledges that new tariffs could definitely hurt the company's bottom line. But it also points to the defense. The company's been busy moving its supply chain to Mexico to get ahead of this. Plus, its brand is so strong it can pass some of those costs along to customers. The argument is, basically, that this is a known risk that's already kind of baked into the stock price.
So let's put it all together now. When you weigh the potential return against the risk, is this strategy a fortress or is it a trap? The report wraps up by comparing it to a couple of other things you could do with your money.
This table lays out the choice so clearly. If you just buy and hold the stock, you're exposed to all the downside from the current price. If you buy a super safe treasury bill, your return is less than half. The short put strategy, though, gives you a potential 9%, and your main risk is that you might have to own the stock at a 17% discount. The source argues this makes it the mathematical sweet spot for someone looking for conservative income.
And I love the final verdict here. The report is very clear. This is not a get-rich-quick scheme. It's not about swinging for the fences and hitting a home run. It's designed to be a high-probability base hit, a strategy that's all about generating steady income and protecting your capital with a huge margin of safety. The worst thing that can happen is you end up owning a great company at a really, really good price. And that really leaves us with one big question you have to ask yourself. This strategy basically juices up a risk-free return to a potential 9%. The price you pay for that extra yield is the possibility of having to buy a stock if it takes a big dip. So the question is, for you, is that trade-off worth it? That's really the heart of the decision this whole report lays out.